Hello everybody and welcome to Economics. Today we will be talking about the Fed. No, not that Fed, but this Fed, Federal Reserve. This will be another two-part series. This video will be more or less of an introduction to the Federal Reserve for those who do not know that much about it. Next will be more to address some of the criticism that the Federal Reserve has received, and also we will be playing an interactive game in said video just to give you a better grasp of the Federal Reserve's purpose and what it is able to manipulate. Now I would like to give a bit of an introduction to the creation of the Federal Reserve and what purpose it served. First of all, if you take out the dollar bill and examine it carefully, you will find the words Federal Reserve Note. It is quite evident that the most apparent purpose of the Fed is to issue money, but be careful, the Fed does not print the money. The Bureau of Engraving and Printing does that. The Fed issues it. The Federal Reserve is the central banking system of the US, and by definition, a central bank is supposed to regulate the currency, supply of money, and interest rates. So in economics, there is a concept of boom and bust cycles. It is a little bit analogous to a bubble as mentioned in the previous video, but more of a cycle of bubbles. The boom can be seen as the inflation of a commodity of a bubble, and the bust can be seen as the collapse and the aftermath of the collapse. Just as we established that large bubbles were not much of a good thing for our economy, relatively speaking, a very volatile, or in other words, very large booms and busts can be seen as a bad thing as well, due to the fact that many innocent people suffer the negative consequences of the bust economy. And that's where the Federal Reserve comes in. Its purpose is to regulate the boom and bust cycles and make sure that the booms are not too big, and thus the busts won't be as big as well. How does the Federal Reserve do this? As I mentioned before, it controls the interest rates. To give a better idea of what exactly the Fed does, I will be using the official website of the San Francisco Federal Reserve as a visual. We are now on the website of the Federal Reserve Bank of San Francisco. In this video, we will be learning about the Federal Reserve, but in the next video, we will be playing the game. Let us take a look at what the Fed says about its monetary policy. To restrain inflation, the Fed can use its monetary policy tools to reduce the growth of money and credit, which tends to raise interest rates and slow the growth of the economy. Monetary policy in this case is said to be tight or contractionary. To fight recessions, the Fed can use its monetary policy tools to increase the growth of money and credit, which tends to reduce interest rates and spur growth of the economy. Monetary policy in this case is said to be easy or expansionary. So just to clarify here, the Federal Reserve uses its monetary policies to keep the boom and bust cycles tight or easy. Let's look at what the Federal Reserve says about its discount rate. The Fed can raise or lower the discount rate, the interest rate charged to banks that borrow reserves directly from the Federal Reserve banks at what is called the discount window. An increase in the discount rate signals a tighter monetary policy, while a decrease in the discount rate signals an easier monetary policy. Recommendations to change the discount rate are made every 2 weeks by Reserve Bank's boards of directors to the Fed's Board of Governors, which then determines whether to change the discount rate. And to clarify here, this is the interest rate that the Federal Reserve sets when commercial banks borrow from it. This is to limit the money supply and keep the economy stable. Next and lastly, we will be talking about the Fed's open market operations, and we will be skipping the reserve requirements because they are not really used anymore as frequently and are not as important. So, open market operations. The tool most frequently used by the Fed to make adjustments in the availability and price of short-term funds to banks, and the most important policy tool is open market operations. This tool is the responsibility of the FOMC. Open market operations involve buying or selling government securities for the Fed's portfolio. This is done by the New York Reserve Bank's trading desk. When the Fed buys government securities, the seller receives funds from the Fed that it puts in its bank. This increases the bank's reserves and its ability to make more loans. As this occurs, the overnight interest rate banks charge each other for borrowing reserves, called the federal funds rate, will fall. When the Fed sells the government securities, the opposite occurs. When making monetary policy decisions, the FOMC sets an explicit target for the level of the federal funds rate, one that it believes is consistent with the Fed's economic objectives. Open market operations are conducted frequently to hit this Fed funds rate target. Change in this target will also change other short and long-term interest rates. So this is probably one of the most important things you absolutely have to know about the Federal Reserve. Right now, what the Federal Reserve does is called quantitative easing, and we will be going a bit more in depth about that in the next video. What's absolutely imperative to know is that the open market operations that the Federal Reserve does is how it actually changes interest rates and impacts the economy. So it seems we're finished with this video of the Fed. If you are still a bit confused, don't worry, because in the next video we will be talking about it a little bit more. Thanks for watching. Don't forget to comment. This is Economics.